Welcome back. If you're here for the first time, do one thing right now, hit subscribe, because what I'm about to show you today you won't find on any news channel. And for those of you who've been here, you already know, this channel is only about what actually matters. So what's today's topic? Something buried under every major headline. A shift that's happening slowly, but when it completes it will be the biggest rewrite in financial history. I'm talking about a moment where traditional finance and crypto are no longer competing with each other. Traditional finance is building its home on top of crypto, and if you're making decisions by just watching Bitcoin's price, you're looking at the wrong thing. Let's start with a simple question. When the world's largest asset manager packs $70 billion into a Bitcoin ETF in just 1 year, what signal is it sending? When JP Morgan launches its own tokenized coin on a public blockchain, what is it saying? And when America's first federal stablecoin law gets signed, what does the math tell you about what's changing? Today I'm giving you a new framework not based on price but based on infrastructure. Because once infrastructure is built, price has no choice but to follow. Anyone can launch a crypto ETF, but what BlackRock did wasn't just an ETF launch, it was a statement. IBIT reached $70 billion in within 1 year of launch. No ETF in history has ever scaled that fast. The record was shattered. And this isn't just a numbers game. Think about it: pension funds, insurance companies, university endowments. When these institutions put money into Bitcoin, they don't go to an exchange and buy directly. They need a regulated vehicle, a familiar structure. IBIT is exactly that. Fidelity isn't far behind. Their FTC is already approaching $17 billion. Grayscale is holding its ground. Together they control a major share of the crypto ETF market. Total assets exceed $123 billion. But that's just Bitcoin. Ethereum ETFs launched too. BlackRock CETA has already crossed $11 billion in. Here's an important survey insight. Institutional investors and wealth managers were surveyed. 75% said they expect cryptocurrencies to become a permanent part of institutional portfolios within the next 5 years. This isn't a wish list, it's a roadmap, and if 75% of institutional investors are already planning, they're already moving, quietly, while you're watching them wait. A few years ago the headline was that Bitcoin is a fraud? Today that same institution has launched its own tokenized coin on a public blockchain. This isn't just ironic, it's proof of a structural shift. JP Morgan deployed its tokenized coin on a public blockchain network. It connects its massive payment system to blockchain infrastructure. Think about that for a second, trillions of dollars moving daily on a public blockchain. This is not an experiment. This is real business. JP Morgan also launched tools for tokenized fund tracking. These tools provide real-time visibility into investor activity. What does this mean for ordinary investors? When a major bank shifts to public blockchain, it signals that blockchain is now institutional-grade infrastructure. It's no longer experimental, it's operational. There's also a strategic angle. Traditional finance felt threatened by stablecoins, so it built its own blockchain-based deposit systems. These systems are interest-bearing, regulated, and designed for institutions. This is not competition between traditional finance and crypto. This is migration. In competition, one side loses. In migration, both infrastructures merge. There's another concept many people still underestimate: real-world assets. But the data tells a different story. Tokenized real-world assets grew rapidly within a year. The market expanded from a few billion to significantly larger numbers. Future projections suggest massive growth potential. Tokenized government securities saw dramatic increases. Some funds now dominate a large share of this market. What does this mean in simple terms? Assets that were once only accessible to institutions are now coming onto blockchain, and theoretically anyone can access them. This is a fundamental shift in accessibility. Tokenization reduces entry barriers. It allows smaller investors to participate in opportunities that were previously out of reach. One example shows how minimum investments dropped drastically after tokenization. That is real democratization. Practical, blockchain-powered democratization. McKinsey projects the RUA market could reach $2 trillion by 2030 and in a bullish scenario potentially $4 trillion. When even 1-2 of the world's $147 trillion equities market moves on-chain, what happens to crypto infrastructure? Think about it. July 17, 2025 was a date that will be a milestone in hindsight. That day America signed its first comprehensive federal cryptocurrency law called the Genius Act. It marked a defining moment in U.S. financial regulation. It offered long-awaited clarity for stablecoins while creating new layers of accountability. Stablecoins should not be considered boring. Over $11 trillion was transacted on the Solana network alone in 2025 through stablecoins. That represents a parallel financial system. The Genius Act set rules for stablecoin issuers. It introduced mandatory one-to-one reserve backing. It required regular audits, it enforced clear disclosures, it clarified that payment stablecoins are not securities or commodities. Instead, they are their own category. This regulatory clarity opens the door for institutions. Previously there was uncertainty and nobody knew if a stablecoin project would receive an SEC notice. Now that risk is significantly reduced. Stripe took advantage of this clarity. It acquired Bridge for $1.1 billion. It launched stablecoin financial accounts across 101 countries. PayPal expanded Pust across Ethereum, Solana and Stellar. Visa launched USDC settlement for US banks. This allowed banks to settle obligations using stablecoins instead of fiat. Initial integrations were on the Solana blockchain. All of this happened within a single quarter. Congress is still working on the Clarity Act. It will set a framework for broader digital asset regulation. It will clearly define SEC and CFTC jurisdictions. JP Morgan analysts have stated that if the Clarity Act passes, it could mark a structural turning point for digital assets. It could also represent a major bullish catalyst for 2026. We are not at the end of regulation, we are at the beginning. The beginning is usually the accumulation zone. There is one thing almost everyone missed. Vanguard updated its policy in late 2025. It allowed clients to trade crypto ETFs after years of blocking crypto products. This is not just a platform change, it is a psychological shift. Vanguard represents conservative long-term investing. When Vanguard allows crypto, it gives financial advisors confidence to recommend it to clients. 32% of advisors made cryptocurrency allocations in 2025. This is an increase from recent years. The percentage continues to rise. A global survey found that 55% of hedge funds are now invested in crypto. This is up from 47% a year earlier. The average allocation is about 7% of assets. This is not a slow drift, this is acceleration. Now we come to where the actual decision happens. Institutional money is selective. It does not buy everything. It follows criteria such as regulatory clarity, ETF access, real utility, and institutional partnerships. Bitcoin and Ethereum are already accessible through ETFs. They already have over $123 billion in assets under management. They are already proven. Solana and XRP ETFs have crossed the $1 billion milestone. This signals a growing appetite for diversified crypto exposure beyond the top two assets. Ecosystems tied to tokenized assets where real-world assets are coming on-chain, the infrastructure tokens powering that migration carry real importance. Stablecoin-adjacent plays regulated stablecoin issuers post-Genius Act or infrastructure companies building the stablecoin rails themselves. But here's my clear warning, and this is where I differ from the standard narrative. Don't invest in an asset just because of the institutional adoption story. An asset having institutional adoption is useful, but if that asset isn't actually doing anything with real utility, it will eventually fail. Institutions make mistakes too. History has examples. The real filter is this wood blockchain infrastructure. Be weaker without this asset? If yes, there's value. If no, there's just narrative. One more thing to understand something most people don't grasp: where are traditional assets right now? Equity markets are volatile. Private credit is under pressure. Gold's correlation is uncertain. Real estate is facing liquidity issues. Bitcoin did something interesting in 2025 when gold entered a technical bear market and equity markets experienced significant volatility. BlackRock and Fidelity were collectively purchasing $400 million in Bitcoin. Analysts noted these were separate allocation decisions rather than a direct rotation, but the signal was clear. CME Group's chief economist Eric Norland noted that Bitcoin's relationship with traditional safe haven assets such as gold remains near zero correlation, meaning Bitcoin is a genuinely uncorrelated asset in a portfolio. For portfolio managers, that could be even more valuable than gold in one sense. And the macroeconomic environment is now pushing institutions that previously stayed away from crypto: insurance companies, sovereign wealth funds, family offices. In the Nickel Digital Survey, 66% of institutional investors said they see cryptocurrency as the asset class with the biggest opportunity to generate attractive risk-adjusted returns over the next 5 years. 66%, that's a majority. I want to use a simple framework to close today. Infrastructure cycles have 3 phases. Phase 1: experimentation. Small players try things. Some succeed, most fail. Risk is high, prices are cheap. Phase 2: institutionalization. Big players build infrastructure. Prices remain relatively suppressed because retail is confused. But the foundation is being laid. Phase 3: adoption explosion. Infrastructure is complete. Capital floods in. Price reflects utility. Retail arrives late. Through 2024, we were between Phase 1 and Phase 2. Today in 2025 to 2026 we are in the deepest point of Phase 2. BlackRock built the ETF financial infrastructure. Genius Act passed regulatory infrastructure. JP Morgan moved to blockchain payment infrastructure. Rua market crossed $18 billion asset infrastructure. When does Phase 3 begin? Nobody knows the exact date. But when the Clarity Act passes, when 401,000 crypto access opens up, when more ETF products launch, those are the triggers, and an important psychological point when Phase 3 starts, it looks obvious from the outside. Of course this was going to happen. But in Phase 2 where we are right now it doesn't look obvious. There's doubt, there's volatility, there are negative headlines. This is exactly the environment where smart money builds its positions. Now I want to be realistic because this space is full of people setting unrealistic expectations. First, position sizing matters. No matter how bullish Bitcoin looks, a concentrated bet is never responsible. Institutional investors themselves keep an average of no more than 7% of their portfolio in crypto. Second, be clear about your time horizon. This is not a 90-day trade. This is a structural shift that plays out over quarters and years. If you're making decisions based on daily price action, you're playing the wrong game. Third, filter your assets. Is there regulatory clarity? Is there ETF access or a clear path to it? Is there real utility that supports institutional adoption? If the answer to all three is yes, then consider it. Fourth, monitor the macro environment. Fed decisions, Clarity Act progress, tokenization milestones, new ETF approvals, these are the indicators that actually matter. Not social media sentiment, and one important caveat: I'm not a financial advisor. This is my analysis, research-based, but your decision should be your own. Whatever you do, do it informed. So I want to stop here and tell you one simple thing. People who are only watching price, they're in a forest counting trees while the entire landscape is changing around them. BlackRock has a $70 billion Bitcoin ETF. JP Morgan is on blockchain. The Genius Act became law. The Rua market tripled. Vanguard changed its policy. 55% of hedge funds are in crypto. 75% of institutional investors are planning crypto allocations in the next 5 years. All of this points in one direction. Traditional finance is migrating to blockchain. Crypto isn't being integrated into traditional finance. Traditional finance is adopting crypto rails. The difference is that big, and understanding it matters. The infrastructure being built today is tomorrow's plumbing, and the people who are close to the plumbing today control the pipeline tomorrow. Think about your positions with that lens. Hold your patience with that lens. And if this analysis was helpful, share it, like it, subscribe. Because this is where signals get decoded every day instead of being packaged as noise everywhere else. See you in the next episode.